Good day and welcome to Battle North Gold's presentation at the Denver Gold Explorer and Developer Forum 2020. My name is George Ogilvie and I'm the President and CEO of the company. Today's presentation is actually on our website. Obviously we have some forward-looking statements, so I draw your attention to the cautionary language and would advise you to read this at your own discretion from our corporate presentation on the website. Let's talk a little bit about the value proposition for Battle North Gold. Battle North Gold has a very accomplished management team that has a proven track record of turning around difficult assets and broken stories. Last year, we produced a preliminary economic assessment on the Bateman Gold Project with very robust economics. When you start to consider today's spot prices, then obviously the KPIs on the economics look very, very attractive. The project is essentially shovel ready. We have most of the major permits already in place, and we believe on the completion of a positive feasibility study which will be issued very shortly, and the approval of the board, within 12 months we should see first gold production on the ground in the second half of 2021. Battle North Gold also controls 28,000 hectares of land in Red Lake, giving it the second largest land package in one of the most prestigious gold mining camps in Canada, if not the world. A little bit about COVID-19. Based on the current stage of the evolution of our company, COVID-19 has not affected the company's business in any way currently. The executive team since March the 12th have all operated and continued to work from home. There's no corporate travel. And with only 30 people in on the ground in Red Lake, and many of those people being shift workers, a site currently sort of lends itself naturally to social distancing. So I'm happy to report that there have been no COVID-19 cases within our workforce. Obviously, our main tasks this year involve underground diamond drilling, including infill drilling and exploration, with those programs ongoing. And our feasibility work is being conducted by third-party consultants who are all working remotely from home. And we have alternate designates in place so that if any of the principals conducting the feasibility study were to become ill or sick and not able to work, we have an alternate that can step into their shoes at a moment's notice. The company just completed a bought deal, and today we have approximately 69 million Canadian dollars cash in the bank and are well funded. We talk a little bit about the balance sheet in conjunction with the cash on the balance sheet. We also have an outstanding debt which belongs to Sprott Lending. We recently renegotiated that debt and pushed out the maturity date to December 31st, 2021. We strongly believe that by the end of this calendar year, we will have refinanced that debt as part of the project capital financing, i.e. the debt component, and that debt will either have been removed or rolled over. And that would then give us a fully financed solution through to commercial production. Currently right now, about 129 million shares issued on a fully dilutive basis, about 137 million. The options are now in the money. They have a weighted average price of around $1.35, and with a share price of around $1.85, it gives the company a market cap of approximately 240 million Canadian dollars. We're covered by 8 analysts with a target price ranging from $2.75 to $5.50 a share. That's after the project financing. And of course, we have a very strong institutional shareholder registry, with Sun Valley and Franklin Templeton being our 2 largest shareholders, followed closely by Fidelity, RBIM, and Invesco. So a little bit of the high-level economics from the PEA last year, which was based on a gold price of $13.25 US an ounce. We calculate our gold price by doing a 2-year look back and a 1-year forward based on the top 30 analysts from the various banks that cover the precious metal space. Interestingly, when we conducted this exercise at the start of the feasibility study in October of 2019, when it started, our average price was $13.75 US an ounce. So at $13.25 or 1762 Canadian, we ended up with an IRR after tax of approximately 40%, an NPV on the project of 135 million, and about $192 million in real free cash flow, net of the initial 100 million in capital being spent up front. And on the right hand side of the screen there, you can see the breakdown of those monies. As you can see, a lot goes into underground development, approximately 40 million there. Our plan of action there is to put the capital development 12 months ahead of the mining crews, which should help us maintain a much more consistent grade profile to the mill. So with a contingency, we're looking about 101 million of upfront capital. And then there's a working capital period of 20 months where we require approximately 46 million in working capital. Now, over that period, we produce about 44,500 ounces of gold. And at 1762 Canadian dollar gold price, it's 75 million Canadian dollars in revenue from gold sales. That provides us with positive cash flow from operations of 28.8 million. We deduct that from the 101 million, we're looking at about 72 million Canadian, and then with inventory adjustments, it brings us up to about 81 million. If we take out the Sprott loan facility at the end of the year, at that time 14.4 million would be due. So we're looking at approximately 95 to 100 million being the funding requirement to put the project into commercial production. A real opportunity here, however, would be that if the feasibility capex and working capital numbers are in line with the PEA, then if we were selling our gold in the second half of 2021 at in and around spot prices, that could actually bring in well over $100 million in revenue from gold sales, which could allow us to drop the funding requirement by plus or minus 30 million Canadian dollars. Here you can see the sensitivity for the project if we look at the gold price and the exchange rate. Obviously, the base case, as we've already discussed, at 13.25. If we start to consider spot prices, then the after-tax IRR starts to approach 100%. The NPV on the project would be approaching 400 million Canadian dollars, and the real free cash flow over the 6.2 years of mine life in the PEA would be in excess of 550 million Canadian dollars. I'll show you on a slide later on how we believe that the life of mine plan at a similar production profile to the PEA within the feasibility study is more likely to be 8 years. And subsequently, these numbers, all other things being equal, would actually improve. So here you can see a photograph looking down on the site, and in the left-hand foreground, you can see our mill building. The mill was built and designed and constructed for 1,800 tons a day. It currently is only permitted for 1,250 tons per day on average over a month. Several years ago, as part of a bulk test trial mining program in the summer of 2018, we ran the mill 2 weeks on, 2 weeks off. And because we were down for 2 weeks, it meant during the 2 weeks on, we could actually take it above 1,250 tons per day. We found that the mill ran no problem at 1,500, 1,550 tons per day. It seemed to be its sweet spot, 95% metallurgical recovery, and 43% of the gold recovered actually came off through the gravity circuit and the 2 Nelson concentrators that we have. In behind the mill, you can see we have a 720 meter deep shaft with a full functional hoisting system. 10-ton skips that sit over the cage. On a 24-hour basis, if the shaft runs continuously for 20 hours in a day, we can actually hoist in and around 2,500 metric tons per day. There in the center to the right of the page, you can see our tailings facility, fully permitted. We will require a tailings dam lift in the first 20 months of pre-commercial production to accommodate the first year, 18 months of production coming out from the mine once we declare commercial production. In the background there, you can see we have a 200-man camp, which is currently dormant, but it's in pristine condition. And then we have access to fresh water. There's a 44 kVA electrical line right into the mine site. And in the background, you can see the Koshna head frame, and on the center background, you can see the mill processing facilities for the Red Lake and the Campbell mine there, which belong to Evolution Mining. The other key point to note on this slide is that we have in excess of 690 million Canadian dollars in tax loss pools. Essentially, that means, certainly within the PEA, that at the end of the 6.2 years of mine life, we ended up paying no corporation tax. And interestingly, there was still 521 million Canadian dollars in unused tax pools at the end of the 6.2 years. Obviously, if the mine life is going to be longer and you want to use more robust gold prices, then there is a possibility that we would eat into more of those pools, and potentially they might even be fully depleted, which would be a good problem to have. So here you can see on the left-hand side, we have a schematic that came out of the PEA. The purple that you see there on that diagram would be a sunk cost. So in conjunction with the shaft, there's also 14,000 meters of lateral development within the mine. And we have a bottom loading pocket that's fully functional on the 685 level that will require an upgrade if we go to production. And we have a mid-shaft loading pocket, which is fully operational as well at the 305 level that is set up for commercial production. The light blue that you see there in cyan is the pre-commercial production development, approximately 6,000 meters. And if you think about a 4x4 meter ramp and being driven at 6,000 Canadian dollars per meter, that would be $36 million. That's part of that 43 million that we looked at on one of the earlier slides as part of the upfront underground development and infrastructure. Now, the green area that you're looking at on that slide is the, once we declare commercial production, it's a sustaining capital development. You can see there the ramp goes all the way to 1,400 meters below surface. And it goes to that level because in the PEA, as well as including measured and indicated, we also get allowed to include inferred resources and the life of mine planning. That is not going to be feasible within the feasibility study, as we can only work with measured and indicated resource, which currently only extends down to about 1,100 meters. So that means the ramp in the feasibility study will only go to 1,100 meters. In cutting out 300 vertical meters of ramping and 5 to 6 haulage levels and the various accesses into the ore body, that will reduce the development by a corresponding amount. However, if the life of mine is going to be increased, then we would expect to see additional development higher up within the mine. Net, we're hoping that the end of the day, the development meters for the feasibility study will come in line with the preliminary economic assessment. The other thing that we did within the PEA is once we had multiple headings, we were only really going at 14.7 or just under 5 rounds of development a day. It's quite conservative. We think there's an opportunity within the feasibility study, and certainly when we move into actual development, of actually going at a faster rate there, and therefore we might be able to declare commercial production sooner and also maybe see an increase in the production over the life of mine. So here we can see the increase in the resources, 43101 compliant resources over the last 4 years since we restructured this project in late 2016. And today we have approximately 1.3 million ounces between measured, indicated and inferred at around 6.5 grams in the ground. The key number here really is the measured and indicated. As I said earlier, only they can convert over into proven and probable reserves. So at a 3-gram cutoff, we're looking at around 979,000 ounces of measured and indicated. And the good news is that in the measured category, the drill density is 8 meters. And in the indicated category, the drill density sits around 19 meters. So the weighted average drill density of M&I is around 17 meters. We envisage when we come to mine this deposit, because we'll have the capital development a year ahead of the mining crews, we would still want to bring in small diamond drills and drill this off on 7.5 to 10 meter centers. When you do that with these high-grade nuggety style deposits, you invariably end up with positive surprises, but also negative surprises. And if you have too many negative surprises and your development's not far enough ahead of your mining crews, you don't have enough stoping blocks, enough optionality, enough flexibility to go to other areas of the mine and maintain your grade profile into the mill. It's one of the reasons why the former management failed on this deposit, and we believe it's a key area that will ensure the more likelihood of success on this project. Now, the resource and reserves within the feasibility study will probably be done at 3.3 grams per ton using a $13.75 US gold price. And at those levels, we're sitting at around 930,000 ounces of M&I. And we're seeing about a 70% conversion of M&I over to mineable ounces or reserves. So 930,000 ounces converting over at 0.7 should be something in excess of 640,000 ounces of reserves. And at 80,000 ounces of annual production, it should give us somewhere in and around an 8-year mine life coming out of the feasibility study when compared to the PEA. As I alluded to earlier, we did put a bulk sample through the mill in the summer of 2018, 40,000 tons in total, 5,000 tons of waste because the mill hadn't been ran for a couple of years, 5,000 tons of low-grade 3-gram material from development into the ore blocks, and 30,000 tons from 3 stoping blocks of approximately 10,000 tons each. Each block was mined completely independently of one another. There was no commingling of ore, and we took over 10,000 underground run-of-mine muck samples. Each stope was stockpiled separately on surface and was ran through the mill completely independently, so we could do a reconciliation exercise right down to the stoping block. We had Golder and Associates come in as an independent third-party engineer to conduct the reconciliation exercise. And at the end of the day, we came to the conclusion that we saw 14% positive reconciliation, 7% higher on tons, 6% higher on grade, and therefore approximately 14% more gold out than what the resource model predicted at the time. And since the very first resource model in 2017, early 18 that we've put out on this project, we've kept the modeling parameters and assumptions very much the same. We haven't altered them in any way. And that's why today we feel that we have something which is more realistic of what we have in the ground and has some credibility and validation behind it, given the success we had with the 40,000 ton bulk sample. What is the ounces per vertical meter? And you can see there in the measured and indicated category, we're sitting at just below 1,000 ounces per vertical meter. And of course, there's some inferred material across strike there, which we're confident we can convert that into M&I over time. The other thing to bear in mind is we have 280,000 ounces approximately between 1,100 and 1,400 level of inferred material. Inferred material qualifies if it's in a 40 to 80 meter drill density. Down there, it's averaging around 50 meters. And we believe over time, as we drive the ramp down, we would do infill drilling on ourselves. We're quietly confident that we can convert that inferred material into measured and indicated Over the last 4 years, a conversion of inferred to M&I is around 90%. So 280,000 ounces converting over at 90% would be 250,000 ounces of M&I. And at a 70% conversion to reserves, it would be approximately about 150,000 ounces, or nearly another 2 years of annual production at 80,000 ounces. That's why today we believe that with no exploration success, only infill drilling, we think the mine has approximately a 10-year mine life from start to finish. Now there's also explore ounces that set down to 1,600 meter level. That was drilled by my predecessors back in 2012 and 13 through to 15. It doesn't qualify for the inferred category and is non-compliant in an explored category because the drill density down there is approximately 100 meters. And this deposit has never been cut off across strike, nor has it been cut off at depth. This slide tries to show the impact or the significance of the tax loss pools. We've compared ourselves to other peer groups, single asset companies with projects in Canada. And you can see here that typically they would be paying about $146 an ounce. That's something that Battle North Gold will not have to pay, certainly within the PEA and the feasibility study, possibly not either. And that's money that can be retained right for the benefit of the shareholders. So a little bit on the schedule. We're now, at the time of filming of this presentation, we're probably about 90% complete now on the feasibility study. It should be issued within weeks of the Denver Gold Forum finishing. We expect a positive decision to move the project forward, and we would expect that by the end of the year, the additional funding coming from the debt component would be in place, and we would have a fully funded project. Regardless, assuming the board approves the go-ahead of the project, we will greenlight the project in November of this year. Interestingly, the feasibility study has all the critical path items starting up in April of next year. So if we were to get underway this year, we would be potentially saving 4 to 5 months ahead of the feasibility schedule that'll go out into the public domain very shortly. Now, earlier in the year, when we started to get some confidence that the feasibility study was moving in the right direction, we started to turn our attention to what we call these close proximity targets, or the string of pearls. And if we start there with McFinley, it sits about 600 meters away from the current production shaft and mill facilities on surface. It was a former producing mine briefly in the late 1990s, early 2000s. Today, it has a non-compliant resource of around 68,000 ounces at 6.8 grams per ton in the ground, and has only been historically drilled a couple of hundred meters below surface. So earlier this year, in the first quarter, we were underground taking chip and muck samples. In the second quarter, we were doing diamond drilling and have released some of those results. And our thought process is that we've now commissioned Nordman Engineering to undertake a resource model, and the hope would be that in the fourth quarter of this year, we could issue a compliant 43-101 for the McFinley deposit. Why do we want to do that? Because similar to the PEA, the feasibility study is showing on average the throughput through the mill will be between 1,300 and 1,400 tons per day, meaning that we're only running the 1,800 ton a day mill at 70-75% of its nameplate capacity. So any incremental tons and ounces that we can send to the mill could have a fairly significant margin associated with them, given that we're already paying for that fixed infrastructure that is already in place. The same is also true for another deposit that we have, which is known as the Pen Zone. The Pen Zone sits about 1 kilometer away from the shaft and the milling facilities. It has previously been drilled from the ice by former management. and we're now following up on those drill results, and we've put out some exploration on this, and the hope would be that in the first quarter of 2021 again put out a compliant resource on the P.Eng zone and hopefully try and see if we can integrate it into the mine plan over the ensuing 12 to 24 months of first production from the Bateman project and commercial production. So a little bit about our land package. It's represented in the light blue or the cyan here. 28,000 hectares, as you heard me say earlier, second largest land package in the camp. You'll notice how it butts up against the red and the pink areas, which are 100% controlled by Evolution Mining, the mid-tier Australian company, producing company that came into the camp in April of this year with the acquisition of the former Newmont Goldcorp assets. So we believe there's lots of synergies between our respective properties. A typical example of that would be East Bay. You can see there a zone known as Gas Zone, which belongs to Evolution. It has a compliant resource of 360,000 ounces at 8 grams per ton, very close to surface. Former management drilled the East Bay property at depth, found mineralization with the same lithology and mineralogy as what we see at the Gas Zone. So we think that the Gas Zone probably extends to depth through this imaginary property boundary onto Battle North Gold's claims. Another area of interest would be that if you draw a line through the Campbell Mine, Red Lake and Koshner on what's known as the mine trend, it takes you right through DMC, McQuaig and Slate Bay, which are fairly high on our priority list, where we want to follow up on some preliminary drilling. Was actually done on those properties again by our former management. Now, of the 69 million Canadian dollars cash in the bank, $10 million of that has to be spent on regional exploration. And we're in the process now of developing our work programs. And we're also in the process of looking now to hire a regional exploration manager who will be given a $10 million budget and asked to spend those monies before December 31st, 2021. So hopefully that can give us some success, because right now Battle North Gold is getting no value for its vast regional land package. So just to summarize, I believe that Battle North Gold represents a very unique investment opportunity. We have a credible management team that has successfully turned around difficult and broken stories in the past. We have a robust PEA that was put out last year using very conservative assumptions. We believe that the feasibility study will show positive economics. And when you start to consider much more higher gold prices and then around spot prices, then the economics look very, very attractive. We have huge tax loss pools, which are not just valuable to ourselves, but could be hugely strategic to other players, particularly when it comes to M&A activity. And of course, over the last 4 years, we've steadily, surely but steadily, been de-risking this project from a technical nature. And I think successful business is really all about good timing. And I think we're certainly timing this perfectly with respect to getting it financed and bringing it into production over the next 12 to 18 months in what I believe is going to be a bullish period for gold over the next 2 to 3 years. And of course, we have huge land package and opportunity for further value creation through a successful exploration campaign. So that concludes my presentation. If you have any further questions, please don't hesitate to reach out and circle back with us. I'll leave you with Alan Candelario's contact details, our Director of Investor Relations and Corporate Development. And with that, I'll say goodbye and thank you for listening.